Welcome to Market Monday from the investment team in the trust department at the First National Bank. We get quite a few interesting data points as we kick off the second half of 2024 with today's trading. Things that are likely to move the markets with respect to interest rates and the equity markets. So let's get talking about some of the data points coming. We get later today sentiment indexes, purchasing managers index in the manufacturing sector, new orders. This gives us an idea of what the outlook is, and that'll come and get fleshed out with factory orders and durable goods orders, which are actual direct demand measurements, which are notably in factory orders expected to show a slowing from 1.6% in the prior reading to 0.6% growth, which could potentially augur an eventual weakening of the economy. We've got the Purchasing Managers Index. Again, these are sentiment indicators. We get productivity, which is definitely something to watch in times of inflation. We've got the trade balance, we've got labor market information, non-farm payrolls, a particularly strong expected number there. 190,000 jobs are expected to have been created. The prior reading to that was 175,000. So in contrast to some of the other data points, which are forecasted to show a little bit of weakening, that labor market is expected to show pretty strong resilience. So it's a mixed message that the economy is sending us on these different metrics. We'll get information on the consumer price index in the morning on the 12th. That's Wednesday next week. That's expected to show a decline. And if that does not show a decline, that could potentially be a market moving event in the morning. Although typically trading on a Fed day is going to wait until the release of the minutes. And they are releasing their rate decision at 2 o'clock on Wednesday. So CPI may not be as market moving as you would expect if it comes in off of the forecasted 0.1% growth. But let's talk about this rate decision, because earlier in the year and last year, it was being bandied about that we were going to see rate cuts in 2024. Now that's looking decreasingly likely. The data is mixed but strong enough that there's really not the case to be made that rates need to be cut at the moment at this meeting. And if these numbers continue to come in hot, the CPI and then the PPI, which will come in after that, that indicates that inflation is still a concern, and the Fed has openly said they're going to do whatever it takes to keep inflation under control, including hold on rates for longer than expected. And that has implications as we pop over to another panel here and we look at the probabilities that are associated with rate cuts. And this is taken from interest rate derivatives. So Fed funds futures are pricing in essentially a 14% chance of a cut coming up at this meeting. That's not heavy. Coming up at September, nearly 50-50. And then, again in December, that's another relatively high-looking probability based on positioning. So what that tells us is, the traders are still pricing in the idea of cuts at the moment, but they may be offsides if the inflation data comes in a little bit stronger than expected or starts to see a resurgence upward in pressure there. So we're watching that pretty carefully. That could have market implications. We'll get producer prices there as well. Interesting to note, the consumer price index is expected to grow by 0.1%, and the producer price index is expected to grow by 0.2%. So that's still bullish for corporate margins. That looks good. We'll see how everything turns out. We don't want to really see hot numbers here, or at least when I say we, the market is probably not wanting to see hot numbers here, and neither is the Federal Reserve. Rounding out next week, the sentiment indicators, which are the future path of demand is potentially forecasted by that. Going into the equity market, we had a slight pullback throughout last week. The market reacted strongly to the upside on Friday and is opening in a stronger zone at the moment, or appears to be on its way to opening in a stronger zone as we're awaiting that data that comes at 10 on sentiment. What is this saying? I mean, the market is trading up near all-time highs, and it's trading in a relatively tight pattern. The average true range is declining, which is a metric of volatility. So average true range being, the average of the difference between the high and the low as we're going up. When we see markets compressing like this, that tends to happen at moments where there's a balance being established between supply and demand. And, that will potentially change quickly when there is some data that comes in unexpected. So we want to pay attention to markets. We don't want to be complacent at the lower volatility. Actually, let's talk about the volatility. That's showing a decline. It's in a low area, relatively speaking, and certainly over the last 5 years, it's in a low point. But volatility, if you notice these spikes, tends to happen from low areas very quickly, so it expands quickly. We'll be again arguing that it's not time to be complacent about the S&P 500 and the market. So going into interest rates, the Treasury curve has not really moved much in the last couple of weeks, but it's moved up quite a bit in terms of year to date, and this is during a period where the Federal Reserve has not raised rates, so it's significant. Even though rates at the longer end of the curve are starting to come down a little bit, that's reflective of the inflation numbers showing a little bit of slowing in their pace of growth, which leads to a maybe lower outlook on the inflation premium that's built into bond yields. So, this potentially is good news if markets are coming down, but these aren't big moves. The 5-year paper moved down 2.2 basis points in the last month. 10 years down 5 basis points, and the 20 years only down 7. So these are not big magnitude moves when you consider that the moves up are much bigger than that. What does it suggest? It suggests that the Fed's not likely to do anything at this meeting, and that eventually inflation is going to be coming under control in this higher for longer environment. That's at least our read on this particular chart. And when we look at the A+ yield curve in terms of corporate bonds, we see the same sort of pattern. This has not really moved in the past month, and it's moved up pretty dramatically year to date. The issue here is, there's not a heck of a lot going on with the corporate bond market. It's not moving. 5.5% for 3-month paper, and then there's a dip in yields over the, up to the 3 and 5 year period before after 10 years we start climbing again. And you can get paper at 5.5, 10 years and out, or a year and in. This is great for fixed income investors who can get some yield, or balanced account investors where they might have a 60-40 portfolio and they're using bonds as a way to deflect or reduce overall portfolio risk and volatility. So coming back to the S&P 500, what do we do here? Nothing. We're going to wait and see what happens. I don't think that anybody's really in a position to forecast where the market is going. It's been going up. It seems to have a lot of strength. So we want to continue to follow our discipline plan. And we say this every time. It's worth saying again and repeating. You don't make changes to a long-term investment plan that's well thought out and put together based on short-term events. So market trading at new highs. What does that mean? Well, we stick to the plan. Market starts going down. What does that mean? Well, we stick to the plan. Hopefully, you found this video useful. And if you have questions, if you have concerns, feel free to reach out to us. We're here to talk. We love to do that. So hopefully, again, you've enjoyed this. Have a great day.